Okay, so thanks everyone for joining. I'm very happy to kick off the penultimate session on monetary transmission. As before, we have 25 minutes for presentations, 10 for discussions, and then we'll have 5 minutes for Q&A afterwards. We're going to start with a presentation from Salim Bahaj at University College London, who's going to speak to us about liquidity risk and interest rates. The floor is yours.
I can go about, I can just shout.
No, it's all right. It's going to be perfect.
Okay, thank you.
Both at the same time?
Oh, I see. Okay, sorry, I'm looking here. Okay, I didn't even realize over there. For my apologies. Okay, so thank you so much for having me. It's great to be here. I really appreciate the invitation and for Reese to actually accommodate me on the program. So this is joint work with Laura, Rob, Jonathan, and Joanna, and I'm in the sort of striker position in the group of co-authors in the middle. So what motivates this paper is the observation that during this decade, we've seen a number of episodes of illiquidity in the non-bank financial sector. So like during the pandemic, we had the dash for cash that was associated with swings in the dollar exchange rate. At the start of Russia's invasion of Ukraine, there was a spike in energy prices, and that caused a liquidity crisis amongst commodity traders. And in the UK, we had a fiscally driven rise in interest rates in autumn 2022 that led to a liquidity crisis amongst pension funds and insurers. And what's slightly odd about all these episodes is that the underlying asset price move was actually, at face value, good for the institutions that were involved. Okay, so think about a commodity trader, if energy prices spike, that should be good for them, they should make profits, right? And in the end, that's what happened to these firms, okay? But the issue was they hedge, okay? They write securities, they use derivatives in order to hedge their exposure to aggregate risk, okay? And those hedges are margined. And when those, when the hedge moves against the hedger, the fund, okay, they face immediate demands for liquidity, okay? Even if the eventual cash flows they're hedging against materialize a long time into the future. Okay, that's sort of the source of these crises. I think actually this is understudied. This phenomenon is been noted before, but we haven't had much work on this issue in the past. And we even decided to label it, which is where the term LASH comes from in the title, which stands for liquidity after solvency hedging risk. And I promise you I won't make too many puns on the word LASH. I'll try and resist the urge to that during this talk. Okay, so let me start with a very simple example of what I'm talking about before I get into the guts of the paper. So imagine we have a fund, think of a pension fund or an insurer with a mismatch on its balance sheet. So I'll talk about interest rate risk in particular here. So a life insurer, for example, may have a 50-year horizon on its life insurance policies, so have very long duration liabilities. And those liabilities will exceed the duration of most assets it can purchase. And most government debt will sort of 30-year duration, for example, okay? So they end up with sort of duration mismatch on their balance sheet, have long duration liabilities and short duration assets, okay? And that means that, you know, when rates rise, they're better off. Even though the value of their assets falls, okay, the value of the liabilities falls by more and they're better off. In contrast, a fall in rates raises the value of their assets, but their liabilities will rise by even more, and they're worse off. So what can they do to fix this? Well, they can hedge. They could buy an interest rate swap, for example. That swap will pay out when rates fall. If they buy the floating leg, sorry, if they issue the floating leg, and that will eliminate the solvency risk. But when rates rise, because that swap is margin, they need to pay their counterparty today the value of the fall in the contract, okay? Even though the reason their net worth has improved is that the value of these very long duration liabilities has fallen, okay? So a mismatch. Long duration cash flows have fallen in value, but you have an immediate liquidity need, okay? They could do things, they can hedge in other ways too. So for example, they could deploy a repo strategy. So they could actually just add very short duration borrowing to the liability side of their balance sheet, and then buy more of these short duration assets. Therefore, they can remove the mismatch in that way. But repo strategies are also margined, so have the same problem. And they could also just set up a fund that does this for them, okay? Have the equity stake in that fund and get the hedge in that way. And actually it replicates the cash flows from interest rate swap, okay? And that, for those of you who sort of are familiar with what happened in the UK, is what an LDI fund is. Okay, that's what they were doing. Fine. So again, by doing this, you also get this liquidity risk. Repo transactions are margined, okay? So that's the case for interest rate risk. There are other examples as well. So this would be a sort of a situation for a European bank in 2008 that have euro liabilities and dollar assets. If the dollar appreciates, they're notionally better off. But if they buy FX swaps, they'll face big liquidity needs. And that can prompt crisis in the swap market. You can think about energy funds having similar mismatches, or even infrastructure funds with real assets and nominal liabilities. They need to buy inflation swaps to hedge the risk, okay? So this is a broad concept. The main idea is that hedging can reduce solvency risk, but in doing so, increase liquidity risk. So we're going to focus primarily on interest rate risk in this particular paper, but it's an application, albeit a sizable one. And we can use UK case to look at how things play out in the data. Okay, so that's the plan. So I'm going to do several things in the paper. The first is measurement. Okay, so I want to measure lash risk for UK non-bank institutions for the universe of them, basically through time, arising from sterling interest rates. That's usually repo and swap contracts. And I'll show you where it's concentrated in that sector. And unsurprisingly, it appears in the area of the financial system where there is this duration mismatch, which is the pension fund and insurance sector. It's large. So at this peak, if there was a 100 basis point shift upwards in the yield curve, that would wipe out the cash of the pension fund and insurance sector. And also what's interesting, and our sort of main focus for the first half of the talk, is there's a negative correlation with the level of interest rates. So as interest rates fall, these funds take on more liquidity risk, okay? And in the sort of middle part of the paper, we argue that's causal. We have a strategy to show that using cross-sectional variation amongst funds. And the mechanism we have in mind is that a fall in interest rates, if you think about sort of risk-averse fund, lowers its solvency, okay? And it's facing a sort of solvency liquidity trade-off when it comes to hedging for the reasons I described. And so as it becomes less solvent, it becomes more risk-averse, it demands more hedging, and therefore takes on more liquidity risk, okay? Now, that means that low rates raise the amount of liquidity risk taken by the sector. It also means that if rates spike very sharply, you're more likely to have a crisis, okay? And that's what happened in autumn 2022. My one pun in the slide deck, there could be a backlash if there's a sharp rise in interest rates. And what we show is that during the autumn 2022 mini budget crisis in the UK, the funds that had high lash risk are the ones that are selling. So you can sort funds on this basis to measure how they sold. Okay, so let me start with just the measurement. So what do we mean by this concept? So imagine I observe a particular hedging contract, I, okay? I can think about the liquidity need generated from it, given a given change in interest rates, so upward shift in the yield curve, for example, as the change in the MPV of the contract multiplied by, well, given a given change in the interest rate. Okay, that's called cash duration or PV01 in the sort of hedging literature, times by how much that given change in MPV is margined. Okay, we call it lambda I. It turns out in the interest rate context, lambda is actually pretty close to 1. Okay, so actually it's just cash duration is what we're picking up. But in other contexts like commodities, it can be quite different from 1. You have bigger impacts. Okay, we're going to abstract from a margin spiral. What's a margin spiral? It means when you have a sharp swing in asset prices, these margins change. You have a bigger response to a given change in NPV. We're just going to say, given a certain level of margining, how much does a given change in NPV generate liquidity needs? Okay, so that's one avenue we shut down. So in terms of our data sources, I won't dwell too much on this, but we see basically the universe of transactions in the swap and repo market. So we can measure all these positions on all these transactions in the UK. We're going to aggregate lash risk arising from both the repo and swap strategies at the institution level. And our sample period will run from 2019 to April 23. Okay. This picture here is just showing you that my illustrative diagram that I started with on my second slide is kind of there in the data. So what I'm plotting here on the left is what's called the funding ratio of the UK pension fund sector. It's the ratio between the red and green boxes on my balance sheet that I had to start with. So when this line is going up, it means those funds are getting more solvent, okay? And you can see that for the sort of 2018, 2019 period, this is less than 100, which means that actually there was a negative funding ratio. The net asset value of the pension fund sector was negative in the UK, and then it shot up from 21 to 23, and now you have a sort of 40% net asset to asset ratio. So their assets are worth 40% more than their liabilities. What's interesting about this is that you can see, you just compare these patterns to movements in the yield curve, which is the right-hand side chart. Their solvency position is clearly heavily correlated with a level of rates, okay? And that suggests that yes, they do have a situation where their assets are shorter duration than liabilities, right? We're seeing this pattern. It also suggests that even if they are hedging, they're not perfectly hedging. Okay, so there are situations where movements in interest rates are moving around their net asset values. Okay, it's sort of a motivating plot, just to make that point. Now, what I'm showing you here is our measure of lash risk. Okay, so this is showing you. Imagine there was a 100 basis point increase in the yield curve on any given day. Okay, given the strategies we see out there, the transactions we see out there, what would that mean in terms of liquidity needs for the non-bank financial sector in the UK? Okay, and we've scaled this by the total cash and cash equivalents available for the insurance and pension fund sector in the UK, who end up actually holding most of this risk. And what we're seeing is that, at its peak in March 2020, a 100 basis point movement in the yield curve would have drained about 85% of the cash and cash equivalents of the entire sector based on their hedging needs. Okay, so this is substantial. What's even more interesting is that if you just plot this against the yield curve itself, okay, there's a very clear negative correlation. Okay, so you're seeing that when interest rates fall, these funds take on more liquidity risk. As interest rates rise, they do the opposite. Okay, so we want to ask the question: is there a pattern whereby a fall in rates encourages liquidity risk taking? Is this a correlation, or is it something causal here? Okay. So the mechanism we have in mind is one where low rates reduce the solvency of the institutions involved, and that raises demand for hedging, which in turn generates liquidity risk. So we have a little model in the paper to explain how that mechanism works. I won't go through all the equations. I'll keep it brief, but I'll give you the intuition here on this slide. So we have a situation where, imagine you have a fund that has a perpetual liability. So every period has to pay back some fixed amount of cash flows to its members. Imagine some pensioners that owes money to, and a portfolio of assets. And it's managed by a fund manager that has a fixed investment horizon. Okay. If we have four ingredients, one is a duration mismatch. So there isn't a perpetual bond that the fund manager can buy to hedge the perpetual liability that it has. Instead, it must use derivatives as a hedge. Okay, and if we believe that deficits are costly, so situations where the fund has negative asset values are somehow costly for the fund manager, then there'll be a motive to hedge. There'll be a kink in the objective, and that generates effective risk aversion in the part of the fund manager. Okay, if the fund manager can buy longer duration assets as a partial hedge, if we assume that selling those assets or repoing them has some liquidation costs, and that holding liquid assets is somehow expensive, maybe due to a convenience premium, then you get this liquidity solvency trade-off. So thinking about the optimal hedging condition, you get an expression which looks like this. Okay, let me just talk you through it. Kappa is like a parameter that governs the cost of a deficit. Okay, a cost of being insolvent in terms of the balance sheet of the fund. This is the probability of insolvency, and this is the expected change in interest rates given insolvency. Okay, and the fund equates this to the cost of illiquidity. So C is a parameter that pins down how costly it is to liquidate your longer term assets. This is the probability of having illiquidity on part of the fund, and this is the expected interest rate conditional on being illiquid. Okay, so what's happening here is that you can interpret the left-hand side as the cost of insolvency and the right-hand side as the cost of illiquidity, and the fund hedges to the point where it equates these two things. Now, what's interesting about this is if you look about the interest rate, okay, the level of interest rate pins down this probability here. As rates fall, funds lose, they become less solvent, okay? So the benefit of hedging rises, okay? But actually what matters for illiquidity is not the level of the interest rate, but the difference, okay? So low rates raise the benefit of hedging, movements in rates affect the cost for liquidity, okay? So periods of low interest rates are associated with a lot of liquidity risk. Periods of volatile rates are associated with less hedging, okay? That's how I sort of think about the conclusions from this. Okay, so we want to test this idea on the data. We're going to use a cross-sectional strategy to do that, okay? And we have, for our funds, their balance sheet positions. We can measure the duration of their assets. And we know that funds of shorter duration assets will experience higher capital losses and hence greater solvency risk when rates fall, okay? So that means that funds of low asset duration should disproportionately increase lash risk when R decreases if you believe the mechanism I just explained to you, okay? So we're going to basically follow a sort of shift share type approach and run this regression here where we say, look, what's the change in lash risk at the fund level, fund J, in particular quarter T, okay? And this discretionary here just accounts for the fact that there is actually mechanical movements you can get in this liquidity risk measure due to the convexity of the underlying transactions which we adjust for. Then we regress this on a fund fix effect, the change in the yield, and the change in the yield interacted with the initial duration of the fund's assets, okay? And this beta 2 here will tell us, is there a sensitivity based on how much this fund solvency will change for a given level of interest rates, okay? So here are the regression results. So these signs are as you would expect. So what this is saying is that if interest rates fell by 100 basis points, the average fund would increase its liquidity risk taking by 133%, or 1.3 log points more accurately, okay? But what we're interested in is this coefficient here, which is on this interaction term. And that's saying that as the fund has longer duration assets, so its solvency deteriorates by less as interest rates fall, they should take on less liquidity risk. And that's exactly what we see, okay? So it's saying that if I move one standard deviation up in terms of my duration of my assets, my liquidity risk taking will fall by around 0.9%. Or more precisely, a fund which is in the upper portion, with one standard deviation up of the distribution in terms of its duration, will take on just 44% extra lash risk in response to a 100 basis point fall in interest rates. Okay, this coefficient here is remarkably stable as you introduce more fixed effects to control for identification issues. Right, so that's the build-up. Okay, we've seen that low rates cause funds to take on liquidity risk. Now, the issue is that if interest rates spike sharply, okay, that risk is going to materialize and then going to start selling. Okay, and during our sample, we had exactly that sort of episode, which was the mini budget crisis in 2022. Okay, and the key point here is that the 30-year yield jumped by 140 basis points in 3 days. And the hypothesis is that that's exactly when you have large margin calls from your hedging and funds start selling. Okay, so what's interesting is, can pre-crisis lash exposures predict the selling? I won't go through all the exercise. I guess I'm almost out of time. Yeah, like 5 minutes. Yeah, but let me show you this chart, which just tells the story very, very clearly. What I'm doing is sorting here our cross-section of funds into 4 different quartiles, okay, based on the level of ex-ante lash risk before the announcement was made in September 23. So this is the fund of the lowest lash risk. This is the fund with the funds of the highest lash risk, okay? And you can see prior to the announcement of the fiscal package, they all behaved in very similar ways in terms of their selling in the bond market, okay? Then the ones that had high liquidity needs or high exposure to interest rates that would then drive liquidity needs were the ones that end up selling, okay? And actually the funds that received liquidity, they were the ones in the bottom quartile, were the ones that did lots of buying, okay? So you see this pattern emerging quite clearly. And you can show that in the regression, but I won't go through that with you just to save some time. So what's interesting about this is why. I mean, why given you have assets on your balance sheet, you're not completely encumbered, what explains why you can't actually get the liquidity you need given your solvency is improving, okay? And we explore that in the paper quite a lot. There's a whole section on this. But there's several reasons. The first is that actually there's capacity constraints on banks to provide that liquidity. And we show that if you have an existing relationship with a bank that was already charging a high borrowing cost to these funds, then actually you're more exposed to the last measure, you sell by more. It's also the case that a lot of pension funds, about half, don't even have borrowing relationships in the repo market. They have no means to quickly raise cash. And amongst those funds, the half that have no relationship, again, they're even more exposed to lash risk. They're more likely to sell assets which are falling in value. So the idea is it's hard to repo a bond where prices are falling very sharply. And also there's coordination issues involved with these pooled LDI funds, which I haven't had time to talk about, but the nature of LDI made problems even worse in that market. Okay, so these are the reasons why it's actually sometimes hard to raise cash when you need it. Okay, so what's the implications of this? So from a macro perspective, or macro potential perspective, what we're saying here is that periods of low rates followed by a sharp increase can lead to liquidity crises amongst non-bank actors that have duration mismatch, okay? And more broadly, you can think about that applying also to swings in exchange rates or commodity prices as well, okay? Is this a problem? Well, one thing to notice is that this risk is materializing precisely when solvency is improving, okay? So these are responsible institutions that are hedging themselves against risks to their solvency, okay? It's not the case they're sort of behaving in an excessively risky manner. It's not obvious they're sort of, taking on excessively risky investments, for example. So what's that mean for policy? We have a sort of deviation from the standard issue with Badrock's dictum, which is that you want to discourage excessive risk-taking by lending at a penalty rate. Here, the moral hazard problem is much less clear, okay? The alternative is to think about, loosening margining rules and preventing these contracts having this liquidity risk associated with them. But at the same time, the margining is actually also a solution to a contracting problem. So it's not obvious you can fix this by having loosening margining contract. The third thing I should say here is that just having better liquidity management on the part of the funds involved may also be a big part of the solution. Okay, so I think I'm bang on time, and I'll stop there. I look forward to your discussion, Maite.
Thank you very much, Salim. To discuss the paper, we have Atek Malkazov from Queen Mary University, London.
Can you hear me? Good, excellent. You skipped the interesting part, all the equations and everything. Come on.
There we go. There you go.
Right. Well, thank you very much for having me to discuss this very interesting paper. So the way I understand sort of the main mechanism, or if you feel the friction in the paper is, imagine a pension fund. It will have very different implications for this pension fund, how it sort of mark-to-market profits or losses on, the cash assets and liabilities, which of course, if you, for example, make some mark-to-market losses, you would reassess your solvency, but it doesn't have any immediate impact or any impact on liquidity. Relative to the impact it will have on the hedging portfolio of this pension fund, the liquidity would be impacted immediately through margin requirements. And, now looking at the hedging portfolio, what will happen then is something we're quite familiar with from sort of this Brunner-Meyer-Peterson type of literature. You will suffer losses on your hedge, there will be margin calls, you will sell the assets, there will be price impact, that may lead to further losses and so on. So it'll be kind of a spiral of the type we are familiar with, and this is what the paper sort of tries to look at. But what it makes kind of a stronger point here is saying this need not happen, because in a way, had the other cash held assets and long-term liabilities of these pension funds, had those be included in your considerations of the margins, like maybe they would sort of, have a kind of a consolidated margining account and on whatnot, that should not have happened, right? You should not have had these margin calls and sort of, that's the idea. And this story fits very well the narrative of the the LDI episode in the UK, as we know from a few policy publications by the Bank of England, I believe also the Chicago Fed and so on. So I guess my question is, can we think a little bit about that? This story has a more general application, and that's where my comments are going to be sort of mainly focused. So the very first comment is really just kind of a literature comment. So when I read this paper, it kind of brought me back to an older literature that I recall from around the global financial crisis. There was a literature on the mark-to-market accounting, and it had kind of a lot of the same ingredients, at least conceptually. If you remember this literature, it was both in the accounting and in the finance. It says, well, if you mark-to-market your assets, and for, let's say, some regulatory constraint that may lead to fire sales that can adversely affect liquidity. There may be some, again, spirals, margin spirals happening. And again, that literature said, but this need not happen. If you just thought about it, the institutions to which this applied had maybe a relatively stable liabilities, just you should have let them hold these assets, not take into account the mark-to-market losses, and everything should have been well. Like whether this gives a correct account for the reasons for the global financial crisis, maybe not, or not fully, but just to signal that maybe this literature can help resituate kind of the paper in the context of some older literature by now, more than a decade old. My second comment is kind of related to how pension funds or maybe also insurance operate. And it specifically pertains to the finding of the authors that, when interest rates increase, these pension funds are going to sell bonds, right? So this is the result of this margin spiral. Even as their solvency increase because of the losses they have on the hedge, the pension funds sold, right? This is the liquidity story. Well, this thing would actually, the selling of bonds actually could, and some papers argue would happen without any liquidity considerations happening, right? So pure asset liability management considerations would also lead to a sale of bonds. So consider a fund that actually maintains duration of assets exactly equal to duration of liabilities, right? So there is no interest rate risk in this fund at all. So there will be no liquidity or solvency issues for this fund whatsoever. But it has the convexity of its assets that is lower than the convexity of its liabilities. As interest rates rise, and as this fund would still like to maintain duration of assets equal to the duration of liabilities, it would automatically just sell some of the bonds. So again, liquidity plays no role here, and it would be interesting to see if these two channels can be disentangled, in particularly because some of the drivers of this channel, which is the duration of assets and so on, would be similar to the controls of variables used by the authors. Let me stop here for this particular channel. My third comment is related to kind of this. It's more about the interpretation rather than about the results. So it doesn't affect the empirical results whatsoever. It's more about the interpretation. So it relates to the finding that low interest rates, which also means low funding ratios for pension funds, are associated with high less risk. So when interest rates are low, funds are a little bit under the water, and they hedge more, right? They enter more of these swap contracts where they receive fixed because they really want to have their interest rate risk hedge in that state of the world, right? That's the claim of the paper. So in particular, they do it because they become more risk averse, right? So that's if I understood correctly, that's how the mechanism works. So I actually thought about it in a slightly different way. I used my prior was slightly different, motivated probably more by the US pension funds than the UK, and there could be a substantial difference. So my thinking was that, when the funds are underwater, they actually are kind of gambling for resurrection. So they are not actually being more risk averse. They are, in fact, more risk loving. They are not having any of the cash positions in bond or very less. They fill the duration gap by entering the swap contracts, and then they invest in all the kinds of risky things, maybe MBS, equities potentially, if the mandate allows them to do so. So they're actually risk takers, but still having more of the less risk in the data because they kind of fill the duration gap. So looking at the US, we actually see some evidence for that. In fact, there is, I'm discussing another paper that does some similar exercise with the Dutch data, and they sort of claim something along these lines. So my comment to them would be exactly the inverse. Have you considered that they actually are more risk averse and not more risk loving? So, one set of slides, just change the sign. But at any rate, I don't know the answer, especially not for the UK funds, but I would like to see a bit more discussion here, both in terms of institutional setting, but also in terms of the model. So the authors actually have a very neat model that you've seen kind of very quickly on your slides, and Salim didn't have time to go through it. And actually, but I think even in that model, it has some sort of version of a loss-averse utility function. Even in that model, it is not actually entirely true that when the funds are a little bit underwater, they become more risk-averse. There is some nonlinearity there. When they go a little further underwater, they actually become risk-neutral and may actually kind of betting or gambling. So even in the model, it is not so clear-cut And I think that's an interesting question to understand, right? We know what we are talking about. Although none of this would affect any of the empirical results, of course. It's more about how we think about these results. And let me move to, the final comment. It's related a little bit more to the impact of, these margin spirals, if you will, or fire sales on actual yields. So, conceptually, and you kind of need, so for any sort of demand effects in the bond market to have an impact on prices, you typically need some degree of segmentation, right? So like you are selling these bonds, why somebody is not buying them at their fundamental value, right? There is this idea that someone should not be there to buy these bonds for some reason. So in principle, we just assume segmentation, right? We say, well, these are specialized markets and so on. But for Lash, especially if it's swaps and derivatives, it's a little bit more difficult to argue, right? If all these pension funds, say, make substantial losses on their hedging portfolio, like on interest rate swaps, for example, there is a dealer on the other side that just made a substantial gain of equal size. And that dealer is probably a very active participant in the fixed income markets. Why? The dealer doesn't use that extra liquidity, just came in exactly the same amount to buy these bonds off the hands of the pension fund, at least, in a more theoretical setting. So it's something maybe to think about, and maybe also gives an idea for an empirical exercise to compare the Lash coming from, swaps versus the Lash coming from repo, where this concerns applies less. If there is a differential effect, maybe there is something interesting to say, maybe not, maybe worth trying, maybe not. But at any rate, taking an equilibrium perspective is kind of always good to see who is selling, who is then buying. All in all, I'm running out of time, and that's perfect because I'm done. It is a very interesting paper with a wealth of data and also a wealth of institutional details, and also a very interesting model that I think should come more like out of the appendix and into the main paper, but that may be just my idiosyncratic preference. Thank you.
Okay, thank you very much. I think it's okay with you. Collect a couple of questions from the audience and then we can respond to the discussion in those.
Thanks so much.
If we could get some microphones. Are there any questions? So Andrea up in the middle there, and then David down here in the front.
Thank you. Very nice presentation and discussion as well. I'm going to ask a question that's probably not going to be very clear because I don't think it's very clear in my mind. But I'm trying to think whether you're highlighting some sort of regulatory failure underneath, in the sense that I thought especially pension funds were supposed to be matched on their assets and liability side. So but maybe they're matched in terms of maturity, they have different duration. Is that the problem? So if they're matched in terms of duration, there wouldn't be any problem here, right? They wouldn't need these derivatives in the first place. So if you could say something about that, would be very useful for me to understand better. Thanks.
Should I collect more questions or?
Let's collect one more and respond. That's all right.
Thanks. Yeah, great presentation, really good discussion as well. I learned a lot from both. I wanted to ask you about the policy implications that you just touched on at the very end. So maybe I misunderstood what you said, but it strikes me as this is exactly the sort of case where lender of last resort should be performing its role. So there's no solvency risk at all for the reason you outlined. It's pure liquidity. Isn't that kind of the optimal solution in some way, that you kind of socialize some of that liquidity risk that comes from these institutions doing the right thing?
Okay. So first, let me say that was a great discussion, exactly what we needed. I think, your exercises are fantastic. We should do them. On the risk-taking point, that's the hardest one, I think, to address empirically. I think that my understanding, at least the Batinga and some. I can't remember, how do you say his surname? Sundararajan? Okay. You don't know. I should know this. So they also have a risk averse framework. The idea is that a deficit is always zero duration. So you want to hedge it, right? That's always what you should do with it. And then once you've done that, you can play with other things. And so that's very close to what we're doing, except we have that even when you have a surplus, you get this mechanism coming through. So we're quite close to them, but we covered both parts of things. But I think we should think hard about that. On the convexity point, I agree with you entirely that you have a differential convexity. You can do this. It's that Lash is orthogonal to that in principle, right? But we should control the convexity, which is clearly the right thing to do to that comment, which is great. Andrea, pension funds do not have to match by duration by law. It's not like a hard thing. It's not like a bank which has to match its 2 sides of its balance sheet. And you can see that in the data, right? That's why I showed that picture where clearly they aren't matched because interest rates go up and they are much better off. What happens is if they run a deficit, and this kind of comes back to Aytek's comment on risk taking, is that there are 2 things that can happen. They have to file a plan with the pension regulator to say how they're going to address it, and they can also be forced to take money from their sponsor. Okay. And that's why I think gambling for resurrection is kind of the wrong way of thinking about things, because their sponsor, the corporate that underpins them, does not want that because their cost of capital is much greater than the bonds that the pension funds is investing in. Okay, so actually there is a sense that this loss aversion is there compared to a situation where the fund is bust and they don't care about the outcome. Obviously, as they get much more into deficit, then that can change. But for small deficits, there's the situation where loss aversion will kick in. Dave, on your comment, so I think it's more nuanced than that. I think the easy solution is to say, look, BOE does it all. Then if that's the situation, you ask the question, well, if that BOE can do it, why can't the market do it? So what is the reason why you have these margin contracts? They're the optimal. There's some contracting problem we're solving with these derivative contracts, and their margin even before we had rules that required margining. Okay, so my sense is it's not obviously moral hazard. So most of the theory models of margining actually have moral hazard motivation. It seems to me more like adverse selection. So some funds do have the opposite duration mismatch. Okay, and I don't want to monitor you and figure out if you're a good fund or a bad fund, so I margin everyone, and that issue would apply to the bank too. Okay, so whereas most fund, BOE, I should be clear, too much time at the Bank of England, would apply to the Bank of England too. So, it may be the case that most of the funds you lend to are the good eggs, but there are a few bad ones that actually have the wrong way around in terms of their assets and liabilities, and you're exposed to credit risk as a result. Okay, and that could be the issue with doing that. I think one simple message from this, which we didn't realize, is just how bad liquidity management of these institutions were. I mean, they should have had the ability to borrow from their counterparties more quickly, and the fact they didn't have that ability, or those that had no pre-existing relationship, their sensitivity is double. Okay, so a £1 liquidity need would require double the selling if you had no existing relationship. So I think just having basic liquidity management may be a very simple way of addressing some of these issues. I'll stop there.
Thank you very much. Okay, I think we'll move on to the second presenter, Oliver de Groot, University of Liverpool, who's going to speak about bank heterogeneity, deposits, deposits, and exchange rates. Sorry.
Put the slides on this screen as well. For a second time today, thank you very much. Thank you for the organizers for inviting me onto the stage. This paper is very raw, so I'm very much looking forward to some very constructive comments from my esteemed discussant, and of course from the floor as well. Perfect, thank you. So as everybody I think knows, policy rates have risen pretty sharply in recent years. What may not be so clear is that interest rates on deposits and savings accounts have been much slower to follow suit. In the UK, for example, the UK bank regulator has warned UK banks about exploiting, in particular, the loyalty of savers, of customers. And it's a known fact that customers, in some sense, are loyal to their banks. That the switching rate for bank customers is pretty low. So what we want to do in this paper is think a little bit more about deposit rate dynamics. One key kind of starting point from this is this seminal paper called The Deposit Channel of Monetary Policy, which looks at how monopolistic competition in the market for deposits causes changes in the spread between the Fed funds rate and deposit rates in response to changes in policy. And what we want to do is we want to think about heterogeneity along a few different directions to what they do in that paper. And the key thing we're going to show you empirically is that when we look at periods of financial stress, the banks which are more leveraged, they lower their deposit rate relative to kind of the average deposit rates that are offered in the market. Similarly, banks which are larger, measured here by the size of their deposit rate, their deposit base, also have a tendency to lower their deposit rates relative to the rest of the market during periods of financial stress. And then what we want to do is we want to write down a model of bank heterogeneity to try and capture these facts. And there's going to be two key components of this model. One is that there's going to be financial frictions. There's going to be this occasionally binding constraint, and banks which are constrained and banks which are unconstrained are going to behave very differently during these periods of financial stress. And the second one, to capture this idea of customer loyalty, we're going to have a model of customer capital or deep habits. So to talk you through the empirical analysis, we're going to take data from RateWatch, which essentially surveys banks across the US on the interest rate that they're offering to various types of savings accounts. This data is collected at a weekly frequency. We aggregate it up to monthly, and we have about 23 years of data. If you look at this left-hand panel, this is showing you for one particular product, which is a 6-month certificate of deposit. So this is kind of like a time deposit. It's a fairly kind of homogeneous product the banks offer, but what you can see here is that every blue dot is a different bank offering a different interest rate, and the variance in interest rates that they offer is pretty substantial. We want to look at what these blue dots are doing in a more systematic way. So what we're going to do here is we're going to rank all our banks in the US by how leveraged they are, and then we're going to calculate the average deposit rate for banks in different parts of the leverage distribution. And what you can see here is there's some systematic time varying behavior in how they set deposit rates. So if you look, for example, again on the left-hand side, is that in 2006, highly leveraged banks, which is the dark blue line, were offering deposit rates a good 20 basis points below the average. And that quickly changed direction by about 2009, where they were offering deposit rates which are a good 30 basis points above the average in the market. And if I do the same exercise, but instead of ranking the banks by leverage, I rank them by their size as measured by their deposit base, you can see a picture here, which is that the larger banks, again, very quickly lower their deposit rates relative to the cross-sectional mean in the run-up to the crisis, and then reverse directions again in the period from 2009 to 2011. And so one thing that's important to recognize is that the correlation between leverage and bank size as measured by the deposit base is actually very low. So these are really, we're capturing kind of two different features of banks here. So let's have a more structured approach to thinking about how these banks behave. We're going to run some local projections. The variable on the left-hand side is going to be this deposit rate for a specific product of bank I at horizon H as measured relative to the cross-sectional mean. The key explanatory variable of variation that we're interested in is X. We're going to look at two different options. One is where we introduce a dummy to capture financial stress. This is based on the Ludwigson Financial Uncertainty Index. And second, we're going to look at exogenous monetary policy surprises, taking the series of Jaroszynski, which has a nice data set up to 2024. And then what we're going to do is we're going to create these kind of decile dummies for banks in different parts of the first leverage distribution and then size distribution. And we're going to interact everything on the right-hand side with these dummies so that we can generate decile-specific coefficients for this beta that we're interested in. So this is what it looks like. What I'm plotting you here is impulse response functions. Time is in months, so this is a year along the bottom. The blue are the top 10% of banks as measured by leverage. The red is the bottom 10% of banks as measured by leverage. And the y-axis is showing you the estimates of these beta coefficients at various horizons. And as you can see here is that in response to an increase in financial stress, it's the large banks, sorry, the more leveraged banks, which are lowering their relative deposit rates, whilst the less leveraged banks are raising their relative deposit rates. Similarly, if we do the same exercise, but again, decomposing the bank distribution by size, we can see there's the largest banks by deposit base, which are cutting their deposit rates relative to the cross-sectional mean, and the bottom 10% are raising their deposit rates. I'm going to skip over what it looks like for the monetary policy shock, but we get a very similar picture here. And so what does that teach us? Well, first of all, hopefully you're convinced that there's a substantial amount of heterogeneity in the deposit rate dynamics across banks. And so we really need a model of bank heterogeneity to be able to capture this. Importantly, we're going to need two kind of dimensions of heterogeneity. And so there's going to be two kind of key bank level state variables that are going to be important. One is bank's net worth. So this comes about because there's going to be a financial friction in the model, and some banks are going to be constrained, other banks are going to be unconstrained. And second, we're going to have a model of customer capital, so customer loyalty, and this is going to be a model of deep habit formation. This model that we're going to write down is related to several important papers in the literature. One is my Discuss and Marco's paper on bank heterogeneity. Our model is very closely related to that. And these earlier papers on thinking about pricing dynamics during periods of financial stress. Simon Gilchrist with Egon, who's here somewhere as well, has got some beautiful papers in this regard. So what our model is doing is something in a similar spirit, let's say. So let me talk you through the model. So the household side is going to be fairly simplistic. All the heterogeneity is going to be on the bank side. So we're going to have this representative household. Time is continuous and infinite. The household is going to want to consume, and they want to save via banks. Banks are going to provide them with some kind of liquidity services. And so the deposits that the household holds at various banks is going to show up in the utility function. And because there's going to be a continuum of banks, we're going to have this CS aggregator over deposits held at various banks. So there's going to be this kind of love of variety that the household is going to want to save across banks. The second important feature is that we're going to have this deep habit formation. So this is this S. And so what happens here is that the more you bank with a certain bank, the greater your loyalty, the greater your habit towards banking with this bank. And so there's an evolution equation which captures how your habit stock evolves as you change the amount that you bank with this particular bank. Importantly, the habits are going to be external, so the household doesn't internalize the effect of its decisions on its habit stock in the future, but the bank will. So importantly, the key first order condition that comes out of this is that we're going to have this upward sloping deposit demand curve for households. It's going to have three features. One is going to be upward sloping, so there's imperfect competition in this market. Banks have market power, so that means that in order to be able to get more deposits from the household, a bank is going to have to offer a higher deposit rate. Secondly, this deposit rate is always going to be bounded from above by the risk-free rate because the bank offers liquidity services. And so the household is always going to want to save via banks rather than in the risk-free bond. And so there's always going to be this risk-free rate, deposit rate spread. And finally, there's going to be this endogenous shifter of the demand curve coming through the habit stock, right? So for a higher habit stock, S, what's going to happen is that this household, for the same amount of deposits, is going to be willing to take a lower deposit rate. What do banks look like? Well, as I said, there's going to be a continuum of banks. This is again a Gertler-Crady style setup, which you've seen in several different papers across today and yesterday. They're going to maximize their present discounted value of net worth, subject to a bunch of different constraints. First of all, is going to be this incentive compatibility constraint that the banker can essentially abscond with a certain fraction lambda of the bank's assets. The bank is going to be very simple in the sense that they're going to invest in physical capital, and they're going to fund that investment either with their net worth, their internal finance, or external finance through household deposits. This lambda is going to be important because when we're going to hit the model with an aggregate shock, we're going to change the value of lambda, and that's going to generate our financial stress scenario. So the bank is going to maximize its present discounted value of future net worth, subject to this incentive compatibility constraint. It's going to take into account the fact that it's facing this upward sloping demand curve. Importantly, it's going to internalize the effect of its decisions today on the level of customer capital that it has tomorrow, and so where the demand curve is going to be in the future that it's going to face. And finally, it's going to be governed by the accumulation of net worth, and there's going to be some idiosyncratic net worth shocks to keep banks kind of moving around the distribution. And sorry, finally, I should say that there's going to be some convex portfolio costs, which are going to ensure that there's going to be some banks which are going to be constrained and some banks which are not going to be constrained. So the constrained banks are going to be up against their this incentive compatibility constraint. They're essentially going to be very passive in the way they behave. The ones who are going to be unconstrained are going to face this first order condition. Let me just talk you through it. You know, first of all, the bank would like to leverage up. There's going to be a positive spread between the return on capital and the what you pay out on your deposits. And so by increasing D, you increase your profits. But because there's this market power, the more deposits you want, it's going to mean that your deposit rate that you're going to offer has to be higher. So this is going to be a mitigating effect. These portfolio costs are also going to push against your willingness to leverage up. And finally, this important term here, which is is taking into account this intertemporal choice that by changing the pricing that you offer today, it's going to change the amount of deposits you have today, and thus the habit stock that you have in the future and the demand curve that you're going to face in the future, right? So by being able to bring in more deposits today, you're going to be able to build your customer base. And so that's going to create the key trade-off that we're going to see in this model, right? That the unconstrained banks are going to face this intertemporal choice between either raising their deposit rates today, lowering today's profits, but being able to build their customer capital, build their market share in exchange for increased profits in the future, whilst the leverage constrained banks aren't going to be forward-looking in the same way. The rest of the model at this point is going to be very, very straightforward. The return on capital is going to be common across banks. And for today, we don't have any investment adjustment costs. We don't have the new Keynesian block, but the new version of the model, this is all in there. And so we'll be able to think in the next version more clearly about monetary policy. Excellent. I'm not going to say much about the way we calibrate the model other than to say we try to hit some moments. On some of them we do pretty well, on others we don't do so well, and this is something that we're still working on. So let me finally show you what the results look like. So the exercise that we're going to do is we're going to have a 10% increase in this lambda, this parameter that enters the incentive compatibility constraint of the banks. And so what I'm showing you on this is kind of the key picture from the model. It's showing you the policy function of the banks, both at steady state and on impact of the shock. And so, of course, the policy function is a surface because there's two dimensions of heterogeneity. There's two state variables, both net worth and the stock of habits. And so all we're doing here is kind of taking a slice in two directions. So the top is looking at different levels of net worth for a given level of the habit stock, and the bottom is looking at different levels of the habit stock for a given level of net worth. So if I just show you kind of what it looks like at the top, if we look at the middle, the important thing to recognize is where you see this kink in the graph is where the kind of boundary is between your constrained and unconstrained banks. And to the left, These are the banks that are constrained. So one additional unit of net worth, they want to bring in more deposits. And at the point where you get to this kink, well, an additional net worth, they don't actually want to take on more deposits. And so they actually decrease the amount of external financing they require. And so you can see that there's this downward sloping leverage in net worth. And the left-hand side here, important to recognize, this is showing you the spread between the risk-free rate and the return on deposits. And so, when your deposit rate is rising for a given risk-free rate, this spread is getting smaller. And so what happens, the key thing to look at is what happens on impact of this shock, where we get an increase in lambda. For the financially constrained banks, what you can see is that there's going to be differential behavior between the banks that are constrained and the banks that are unconstrained. So if we look again in the middle panel, the banks that are constrained on the left are going to have to decrease the amount of deposits they take on. They're going to deleverage. The banks that are unconstrained are going to take this opportunity to grab market share. They're going to increase the amount of deposits they hold, and they're going to leverage up. And you can see how that plays out in terms of the pricing of their deposits. So the less leveraged banks are the ones which are going to increase their deposit rate in order to grab market share, and so the spread is going to shrink. Whilst the leveraged banks are the ones which are going to they care about their near-term profits, and so this interest spread is going to widen. In terms of understanding this result about banks of different sizes, on the bottom here, right, what we're doing is we're holding the level of net worth constant, but we're varying the habit stock that they have. And what we can see is that the reaction is very different, right? So here, the banks to the right, all these banks are essentially going to be constrained. The banks to the right of the crossover point are, let's call them the larger banks. And so the larger banks are going to be the ones which are going to decrease the amount of deposits they hold. So they're going to take this moment to kind of exploit the fact that they had a large habit stock, and they're going to take profits relative to the smaller banks. And so this is going to be consistent with exactly what I showed you in the empirical evidence. This is showing you, so I showed you here just in the previous slide what happens at steady state and what happens on impact. This shows you kind of the full evolution of the in response to this impulse response function to a persistent shock to lambda. It's a pretty standard kind of financial tightening shock that investment falls, output falls. Importantly, there's going to be two calibrations on this chart. One is kind of our baseline calibration, and the other one is a myopic calibration, where we essentially switch off this term in the first order condition of the banks, where they don't internalize the effect of their decisions today on how their habit stock evolves in the future. And what you can see is that the effect of this habit process actually amplifies the effect of the shock. More importantly, though, we want to again look at kind of the distinction between our constrained, our highly leveraged, and our unconstrained, our low leverage banks. And here we can see again in the top left-hand panel that it's the unconstrained banks which are going to leverage up. The constrained banks are going to deleverage and lose market share. We look at the third panel on the bottom here, we can see the spread between the risk-free rate and the return on deposits. And we can again see this differential behavior between the two types of banks. That it's the constrained banks where the spread is going to rise, which means that they're the ones who are cutting their deposit rates more aggressively relative to the rest of the sector. Finally, this shows you again what happens when we turn off the effect of habits, and how much the habit formation process amplifies this effect of banks, unconstrained banks, exploiting and grabbing market share in response to the shock, so that they can profit in the future. Let me conclude there as a public good. I'll try and get us back on time by not taking the full 5 minutes that I have left. So as I said, we've got some empirical stylized facts on the dynamic setting of deposit rates across different types of banks in the banking sector. We build a model of bank heterogeneity to be able to capture some of this heterogeneity. But as I said, this is very early work in progress. There's still many things that we have on our to-do list, and I'm sure Mark is going to add some more for me. Thank you very much.
Very much. Discuss the paper. We have Marco Bellafemine from London School of Economics.
Right, is this working? Yeah. All right, great. So let me thank the organizers for giving me the opportunity to discuss this very interesting paper, and let me jump into it. So in terms of motivation, I think Oliver did a great job, but I like one of their graphs a lot, and so I'm still going to show it to you again. So what the authors are kind of doing is they're fitting in this pretty large literature, which is about the deposit channel of monetary policy, which is pretty much all about this, right? Which is the fact that when the risk-free rate, the Fed funds rate, which is the dotted line here, goes up, deposit spreads, the difference between the risk-free rate and the deposit rate, tends to go up as well. But this paper is all about the heterogeneity around that. And so, you know, it's about the heterogeneity, I guess, both in the level of these deposit rates, but most importantly, in this heterogeneity in the pass-through from the risk-free rate to the deposit rate. And so my view on this paper is it's a really nice paper. I enjoyed reading it a lot. And very quickly, what Oliver and Gustavo are doing on the empirical side, they're using state-of-the-art microdata to show, I guess, two main things. So first of all, highly leveraged banks tend to display a higher pass-through, at least during financial crises, from the risk-free rate to the deposit rate. And similarly, big banks tend also to display a larger pass-through from the risk-free rate to the deposit rate during financial crises. Then on the theory side, they build on a standard by now banking model like Gertler, Karadi, Kiyotaki, and they add, in my opinion, two key ingredients to it. So first of all, they're going to have idiosyncratic shocks to banks' net worth. Together with basically they're breaking scale invariance, they are introducing non-interest expenses which are convex in the balance sheet size. And in this way, what this buys them is that they get a bank size and leverage distribution. And in particular, they get non-trivial bank heterogeneity. Bank heterogeneity is going to end up mattering thanks to the breaking the scale invariance. And second, they're adding this customer capital with this deep habits feature. And what this gives them is that then the pricing decision of the bank, which is the rate setting decision of the bank, becomes an intertemporal one. And it's going to interact with leverage, which is, you know, an insight that Egon maybe first had for non-financial firms, and they're bringing it to the financial firms. All right, so for my presentation, I'm going to have maybe two quibbles and then some suggestions about some exercises that I'd like to see in the paper. So let me start with the first one. And my first question is just, you know, I'm not sure whether I was able to fully find a coherent story for the different empirical results they're showing. And so in particular, Oliver didn't have time to go through them. But I mean, the first one, he did have time to show it, which is during a financial crisis, they show that financially constrained banks tend to decrease their deposits rates by more than unconstrained banks. But then they also show that after an exogenous monetary tightening, financially constrained banks tend to increase their deposit rates by more. And I'm not sure these two facts necessarily fit together from the perspective of their model, because we usually think of both of these shocks, you know, a financial crisis and an exogenous monetary tightening as negative shocks. And then, you know, while point one definitely fits with a story in which basically customer capital acts as a substitute for financial capital, meaning, you know, I'm going to eat a little bit of my customer base to generate a financial capital buffer. I'm not sure then point two is really saying the same story. And so more generally, I guess my question is, why do we need these three different empirical exercises you have, which is, you know, this financial crisis, then they have this exogenous monetary tightening, and then they just feed into the local projection the level of the Fed funds rate without using these, you know, high frequency shocks. So are they there only for robustness, or maybe can you exploit them more? Can you learn something more, impose more discipline on the model by having these three different exercises? All right, then my second question is about leverage versus size. So as you saw, all of their empirical exercises, they always look at two different dimensions of heterogeneity. So leverage heterogeneity and size heterogeneity. And And at first I was thinking, okay, these are just two proxies for financial frictions, but actually I think they don't see them this way. They see each of these two dimensions as an interesting dimension on its own. And that's totally fine, but I think maybe by reading the paper, it wasn't too clear to me why, from the perspective of their theory at least, we find both of these dimensions of heterogeneity interesting. So it's clear why leverage is interesting, right? Just because it's going to give us the story that financially constrained banks behave less forward-lookingly when setting interest rates. But I wasn't able to find a clear reason why we should care about size heterogeneity from the perspective of your theory. Another question I have, and I may be wrong here, by the way, but can your model match the heterogeneous response by size that you find? So, you showed us that basically following a financial crisis, big banks tend to decrease their deposit rate by more than small banks. But then, on the right-hand side, I'm plotting your policy function along the net worth dimension, which to me was what I saw as, your proxy for size in the model. This is the policy function for the deposit spread. The blue one is in the steady state, and the red one, orange one, is on impact following the financial crisis. And it looks to me like the deposit spread is going down by more for big banks, which is suggesting that they're decreasing their deposit rates by less. So, it's just, I think, something that you may want to think about for a later version. And then, I think if you really want to claim that size and leverage are both interesting on their own as characteristics to look at in the data, conditional on a time fixed effect, actually size and leverage are not that uncorrelated, at least in my experience. So I think it would be nice to control for them jointly in your local projections. I try to replicate your local projection with the joint controls, and I think everything goes through. So, you even have less equations to show. I think it's just, it's just better maybe for you to show everything controlling jointly. And then finally, let me give you maybe some suggestions. So I think that's a very cool framework you have, and there's a lot of interesting exercises you can run. And I was thinking about three. Maybe they're not necessarily the most interesting ones, but to me they seem natural. So the first one is I feel like the motivation for your model is really about this heterogeneous pass-through from the risk-free rate to the deposit rate. And so maybe it would be interesting to look at a counterfactual where you shut down the heterogeneity in the pass-through, which I think probably you can do when you bring the elasticity of substitution between deposit varieties to infinity. And that's different, I think, from the myopia exercise you're doing right now, right? Because here I'm plotting the responses of the deposit rate under myopia, which are the circled lines. And you can see how there's still some heterogeneity between constrained and unconstrained banks in the response of the deposit rate to the risk-free rate, which suggests that there's still heterogeneity in the pass-through. And so I just think it would be interesting to see what happens once we shut down the heterogeneity in the pass-through. And maybe it would also be interesting to explain, what do we learn from the two different exercises. I understand here we are kind of shutting down these, customer capital channel, or at least the intertemporal part of the customer capital channel with the myopia. But I thought that would have been an interesting exercise to look at. And second, and maybe I think, at least to me, that's the most interesting exercise you can run. So I think in your model, contractionary monetary policy and monetary policy in general is going to reallocate deposits from financially constrained to financially unconstrained banks. And I think that's interesting, because then you can basically think about what does this mean for allocative efficiency in your framework. And so a little bit do what Baki, Fari, and Sangani do for non-financial firms. You could maybe do it for financial firms. Because we usually think of financially constrained firms as being too small compared maybe to the efficient equilibrium. And so I think there could probably be something interesting that you could say relative to these. And also because you have convex non-interest expenses. Now, I'm not sure whether that's necessarily an interesting channel, but the fact that you have convex non-interest expenses implies that this reallocation of deposits from one bank to another is going to have implications for efficiency. And also, I think, because of this in your framework, monetary policy is going to have non-trivial dynamic effects on deposit concentration and deposit market power. And so that could be, something interesting to look at as well. And then finally, I'm not sure to what extent this is an interesting exercise, but I think you could maybe do a bit more to try to think about to what extent you really have state-dependent transmission of shocks in your framework. So a little bit like Cotonello-Wimberry do. And so, for example, does it matter whether the highly leveraged banks are the banks with a large deposit base or with a small deposit base and this kind of stuff, right? I think this is an easy exercise that you could try to run. But so I think I'm running out of time. Overall, I think this is a very nice paper. It's timely and it's very policy relevant. As I said, is a cool framework. There's a lot of interesting exercises that you can run in this framework. And overall, I'm looking forward to the next version of the paper. Thanks.
Well, let's collect a couple questions and then we can respond. So, Martin in the back.
Thank you very much. That was absolutely fascinating. Martin Wheel from King's College. One question, though, if I think of the period just before the banking crisis, the banks that tended to offer very high rates of interest on deposits were the banks which looked, let's say, a bit dodgy. The Bank of Scotland, the Icelandic banks, for example. Was that phenomenon present in your model? You seem to be suggesting that banks in difficulties would offer lower interest rates, whereas what I remember is that the interest rates rose and in the end the depositors only stayed with them because they expected to be bailed out in the event of a bank failure. Thank you.
Thank you, Martin. Any other questions? Okay, Oliver, do you want to start responding?
Yes, certainly. Well,
thank you, Marco, for a very nice discussion. I don't have a huge amount to add because I think they're all very valuable comments, and I'm not in a position to be very defensive of what we've done yet. All those things are things that we're kind of on our list to think about. So, in terms of looking at the effects of monetary policy shocks as opposed to kind of financial stress situations, in the paper currently, we have kind of a 3-period version of our model where we think about discount factor shocks. But again, as I said, the new version of the paper will soon have kind of a new Keynesian block in there, I think, which will help us really connect the model to the data better. This question of leverage and size, I was kind of surprised myself at like the low correlation in the data. Whenever we do these regressions, there's still, when we split the sample by decile for leverage, we still have a control for size in the regression. So we are controlling for that. In terms of the counterfactual exercise that we do in the model, again, I think this is a good question. One of the problems we had when you kind of switch off other things is that the steady state of the model changes a lot. And so it's very hard to kind of separate out what is really coming through in terms of dynamics rather than, a steady state change in the model. So that's kind of why we went for this idea of just switching off kind of this term in the first order condition, but maybe it's not the best approach. And then your point on allocative efficiency, I'm not familiar with this Fari paper, so I'll definitely take a look at that. And again, I think the connection that you make to the Tom Winbury paper, I think is an excellent thing for us to look at. And similarly, again, thank you, Martin, for a very nice comment. I don't have anything useful to say in terms of that, but I think it's definitely worth thinking about. I think what you're identifying there in terms of the Icelandic banks as a good example, pre-crisis, as offering very high returns is maybe we need to think about how consistent that is with what we see in the US data and how our model interprets that period. But thank you very much again.
Okay, we do have a couple minutes for additional questions. Are there any additional questions before we move on to the final paper? Okay, then thank you very much, Oliver and Marco. The final presenter is Georg Strasser, European Central Bank, who's going to talk about inflation heterogeneity and monetary policy.
All right. Thank you very much to the organizers for putting our paper on the program. So this is the last presentation of the monetary transmission session, and we have talked a lot about banks and financials. Now I'm going to talk about households for a change. So this is about the effect of monetary policy on heterogeneity along the income distribution, and it's jointly with my co-authors, Miguel and Michael Ehrmann, both are now at ECB. So this cover page is not just a beautiful cover slide, it also frames a little bit what we are doing. On the upper left, you see the euro symbol, means we are talking about monetary policy shocks from the ECB. And right behind our podium is a supermarket shelf, which means we are discussing the inflation on supermarket goods. So it's not the universe, so we don't talk about energy, we really talk about the daily purchases in there. Being from the ECB, whatever you hear from me is my personal opinion and not an official statement. That's obvious, I guess. So heterogeneity has been very present in the literature, especially as a constraint on how monetary policy works, how effective it is. Now and then, there's also an effect on the discussion about the distributional effects of monetary policy. And the discussion mainly centers on these first-order effects on income and wealth. But now and then, the spotlight also goes on to distributional effects via heterogeneous inflation rates, based on how much people spend on their purchases, what purchasing power they have. And this is going to be the focus of my presentation today. And as you can imagine, the key dimensions that we're going to discuss is the shopping behavior of the households and also the consumption bundles, basically, that people consume in their daily life. So research question, I already stated it, has some important precedents in the literature. So there is this paper by Cravino and co-authors for the United States, which basically, in an approach which I explain shortly, shows that the inflation for high-income households, so high-income households, responds less to monetary policy shocks, or vice versa, the low-income households are the ones that are affected the most. And this paper is very interesting, but it is a little bit unsatisfying when you consider some recent other discoveries. So, for example, we know that heterogeneity within product categories, so when you go beyond this high-level product category view, is quite important for the heterogeneity of household inflation rates. So it matters whether you always buy Coca-Cola or whether you buy just any kind of Coke and switch between those products. The shopping behavior goes in the same line. The price paid by households differs a lot between household types. Some switch, others don't. And so what we want to do in this paper is we want to do a deep dive into these supermarket consumption baskets and see what's going on in there in terms of substitution and how relevant this is for inflation heterogeneity between income groups. Well, the minor result is not surprising. Inflation heterogeneity matters also at this micro level, but it's a little bit more deeper and subtle than what these the existing literatures document. So on the one side, of course, we will replicate that the inflation rate of high-income households responds less when you look at the consumption basket, the high level, at top level. But once you dive deep into the consumption baskets and look only at food, then it's actually the other way around. And yeah, in the next 20 minutes, I show you why. So first, let me talk a little bit about the data to explain the tension between these two approaches. And I start with the aggregate approach. That's also the guiding thing in the Cravino paper. So the typical approach is that you have a household budget survey. So that would be the European version of it. It's taken every 5 years. And there you have basically consumption shares across product categories by income category. This you can then combine with HICP sub-indices, which are, again, an index for food, an index for beverages, and the like. And because the expenditure shares differ between income groups, surprise, the product thereof also differs per income group. To show you a little bit about what variation is driving such results, here is a plot of the income shares in the household budget survey. If the bar is below 0, then the low-income households consume relatively more. If it's above 0, the high-income households consume relatively more. And you see that there is meaningful variation. Food and housing is disproportionately represented in the low-income consumption basket, transport, and things attached to that, hotels and the like, are disproportionately represented in the high-income consumption basket. Since the inflation rates along these consumption baskets are not identical, obviously inflation rates are different. With this, you get the standard results, right? So you see here a typical graph, the inflation differential between high and low-income households. If I'm below the zero line, low-income households have high inflation, and most of the time they had. Note that this is a last pair inflation, right, without substitution. And on the right-hand side, you see that as the higher the inflation rate is, the more strongly this wedge goes into against the low-income household. So the low-income household is proportionally higher. Now, well, the downside here of this approach is, of course, I have these consumption shares only once every 5 years. So, I mean, in order to do anything, I have to interpolate or do something there. So I cannot talk meaningfully about substitution. And additionally, I cannot go into the product categories. So within food, I don't know anything. It's just food. I mean, food and beverage, but so no difference between meat and cheese. If I want to go further, I need to have a different data set, and this is the household panel data that we use. We have a panel that covers 6 European countries. And for there already the downside starts. It's not as nicely balanced as the HBS data would be. So for different countries, the panel starts at different times. It's a pretty messy exercise. Nevertheless, what you have there is really a transaction based data set. So some household A with a certain income group buys Coca-Cola 300 milliliters in whatever, a Tesco on a certain day. So that's what you have. You have to aggregate it somehow. And doing this, one can calculate inflation rates. There are some limits on how frequent you can get, but I mean, up to 1 monthly frequency is possible. I mean, beyond that, I would not stretch it, but basically that's what we do. Yeah, so just one caveat is also there because of this high variation. I said I can calculate inflation rate every month. Because the consumption baskets at the household level are very, very volatile, you need to somehow smooth the quantities. So what we do is we take annual rolling averages. So this may sound a little bit of a shortcut. I mean, it's much, much better than what you have in the household budget survey. And it tries to also account for the seasonality in these in the consumption weights. Nevertheless, it's something to keep in mind when you later see the impulse responses. Now, you've seen the left part already. I'm going to the right part now. This is basically what the consumption shares look like in this household microdata. Notice that the vertical scale has smaller numbers than in the household budget survey because we are talking now about just subcategories. But again, there's meaningful variation, right? So the low-income households consume relatively more oil and fat, sugar, chocolate, coffee, tea. The high-income households consume relatively more fruit, veggies, and mineral water and juices and whatever is in there. So there's variation there as well. And if I stop there, I would already get inflation heterogeneity just based on these consumption shares. But we can do more, of course, because we have the microdata. So we can also do substitution. And that's what I'm going to guide you through now. Before I do this, I need some shocks, monetary policy shocks. And so I use the famous monetary policy shocks of Jaroczynski-Karady, which all of you know. So these are the textbook style shocks that after a tightening, stock market should go down and interest rate should go up. Okay, so what do? We do local projections, a la Yorda, done by many people, of these monetary policy shocks, so my phi's, on inflation. So first I'm going to do it on inflation, later I'm going to do it on inflation differential. And what I'm going to plot is always this theta h, so the coefficient on the shock. And there are a bunch of controls. For the details on that, I refer to the paper. So first, let's make sure that what we are doing here is not hocus pocus with data that is not matched to anything that we know about or think about when we talk about inflation. So our setup is always to do a 10 basis point monetary policy tightening and then see what does this do to HICP inflation. And as you can see here, it actually, luckily, it reduces the inflation over time. On the horizontal axis, we have up to 4 years. It's a monthly axis. When we go into food,
it's even stronger. So overall, the effect is the setup is meaningful. Now I can do the same thing looking at the inflation differential. So this was levels, right? This is what we are used to, right? A tightening reduces inflation. Now I'm going to go into differential. What is different? Heterogeneity between high and low income households. So how does monetary policy tightening affect the inflation rate that high income households face differently from the inflation that low income households face? So I take the difference between the two inflation rates. And this is what I'm going to do here. Again, for the HICP basket, I'm still not using my microdata. And you see actually that the line goes up. It's above 0, meaning that the inflation rate of the low income households goes down by more than the inflation rate of the high income households. So the high income household inflation responds less. So far I have basically replicated for Europe the Cravino et al. Result. And now I'm going to go to the microdata. And that's what I'm getting. Yeah, it looks quite different, right? So now instead of going up, it goes down. Means that in fact within the food and beverage for my 6 countries, the inflation rate of the high income household responds more, the last pair index. Now this is not true for all countries in the same way. So we are decomposing our countries, our 6 countries, into 2 sets. In one set of countries where there's a lot of scope for substitution in the sense that the price differences for our, say, Coke Zero 200 milliliter bottle in our panel is very wide. So there are some shops that are really expensive and others are really cheap. That applies to the countries in the middle. And then there are other countries where the range is much tighter, which are the countries on the right. So it shows that this inverted effect that I'm just showing you is driven by countries where there's a lot of scope of substitution. Now, having mentioned the word substitution, the question is what's going on there actually, and how do households respond to these differences? So now I want to discuss a little bit, do households substitute? Do they change their behavior in terms of quantities? Do they change their behavior in terms of how much they shop? But first, let me start with the substitution itself, and therefore I have to look at the Paasche index. Now the Paasche index, again, many of you will have some notion from other papers, so let's again start with the standard approach, not doing impulse responses, just plotting the lines as we are used to. So here in this graph, I'm plotting as a blue line, again, the inflation difference between top and bottom income groups for a Paasche index. So that's the blue line. It's again below 0, meaning that the inflation rate, the HICP style Paasche inflation rate, but only for food and beverages, for the low income households has been higher. The Paasche index after substitution shows a different picture, right? So and that's also in line with the literature. It's above the 0 line, meaning that after substitution, actually the low income households face the lower inflation. So they are substituting. And it varies over time. And it varies over time in a meaningful way. And this is what this scatter plot does. It's the same data as the graph before, just that the dots are not arranged over time, but they are now arranged according to the HICP inflation level. And what you see with the blue dots, it's basically the same scatter plot as we had seen before in the aggregate data. It's a downward sloping line, meaning that the higher the inflation rate, the higher, or the more disadvantaged to say are the low income households. They're facing a higher and higher inflation differential relative to the high income households. The Paasche dots, which are the circles, show a different picture. When we have a low inflation rate, actually, it is the low income households that have a lower inflation rate relative to the high income households. But as the aggregate inflation level goes up, this wedge or this advantage disappears. So at high inflation rates, then despite substituting more, the low income households have the same inflation rates as the low income households. One thing that's hard to see here, but it's nevertheless significant, is that the gap between those two lines actually widens a little bit over there. So the difference is significant. And that suggests, and you will see in a moment the evidence more prominently, that the low income households, as inflations increase, seem to run into some constraint in substitution. Whereas the high income households still have scope of substitution for substituting. They still have products in which they can substitute into. The low income households seem to not be able to go on as they do at low inflation rates. Which makes sense in this because low income households, they are already buying cheap products, right? So if there is no product you can substitute, what can you do? They are already buying at the cheap stores. there's no cheaper store. What do you want to substitute into? So that's a little bit behind this graph. So now these are the same graphs as before for last pair, now for partial. And they look the same as before almost. I can go back. That's what we had before. But they are a little bit with a much more nicer, much more nicely behaved. So you see basically again the same story that the high income households inflation rate responds more to a monetary policy tightening than low income households. However, this is driven only, in a meaningful magnitude, again, with the countries with the highest scope for substitution. Now, the last thing I want to do is take the difference between the last pair and the PASH. And I go right there at the moment, right now. So there you see, let's start with the aggregate. So in the aggregate, after 18 months or so, you see we are below the zero line. That means that the high-income households, after 18 months, are substituting more than the low-income households, disproportionately more. That applies even to the country sets that previously I had said, well, it's a little bit less interesting because not much is going on. Even in this country set, it's at the borderline of significance, but it goes in the same direction. In the middle group, where we had this the widest range of prices for the first couple of months, the sign is the opposite. Where does this come from? Well, this is now the difference between partial and last pair, right? So when you are in the last pair index and you cannot substitute, right, because the quantities are linked, what this reflects is that you are looking for a better price. You're buying the same product with the same weights, but you are looking for something that is cheaper. And in those countries with a big price range, the high-income households in the first 12 months are actually actively substituting more than the low-income households to those cheaper products. So that's why you have this change in sign after the first 12 months. So you see a lot is going on there in terms of shopping behavior. So in some sense, everything I've shown you now is a black box. Of course, we have the microdata, and I summarized them for you. But you may still wonder, are people really behaving differently? Do I see a behavioral change? Now, we don't know who these households are, and we cannot interview them. The only thing we have is this household panel, and we can try to tease out from their purchases some kind of behavioral aspects. And we tried various things, and the two most prominent ones I'm going to show you now. The first one is the repurchasing of existing products, and the second one is how often households go shopping. So first, let me go to the left, the quantity of repurchased products. So what does the definition actually mean? Well, a household buys certain products at a point in time, and the household may buy the same quantity again, or he can substitute into something else. What we are measuring here is really, I bought 5 bottles, Coke Zero, 200 milliliters, and because the price of this Coke went up so much, I reduced my consumption of that Coke type to 3 bottles. That doesn't mean I'm drinking less caffeinated soft drinks. I might buy some other soft drink more. So it doesn't mean I reduce my consumption overall, but it means I'm willing to change my consumption habits. And this is what is reflected here. And you see again that in overall, but in particular in the 3 countries with this wide price range, the high-income households change their consumption habit much more than the low-income households. So that's one of the drivers behind the aggregate results. On the right side, we are just counting shopping trips. So shopping trips are for us days on which a household reports a transaction. And that's not that significant, but it also tells the same story. For in all country groups, after this monetary policy tightening, the rich households increase their shopping trips more than the low-income households. So note again, and that's the key disclaimer, that we have talked about the shopping of food and beverages. We have not talked about energy or other things where these kind of dimensions wouldn't really be the right ones. So that brings me to my conclusion. So as a as I have reaffirmed, is monetary policy affects inflation differently along the income distribution. And it does it at the top level in the way that has been known. So because of this big inflation differences between energy and food, after monetary policy tightening, the high income inflation rate responds less, in line with the literature. But once you dive into each of these categories, and we have dived into food and beverages, then the situation gets more complicated, because there the effect is in the opposite direction. So there actually the inflation rate of the high income household responds more. And this is due to the change in shopping behavior, the differential change in shopping behavior between high and low income households. There's a big difference, as I have a little bit illustrated with my two graphs for the two country groups between the countries. So one cannot say that this applies in all countries in the same way. But nevertheless, the overall result holds. And the big question now is, of course, what would be the net number if I add this top level result and this micro result? Well, unfortunately, I cannot give you that one, because for this, we would need micro data also for energy and the other categories. Thank you very much. And now I look forward to the discussion.
Thank you. We have Ian Clyden, Central Bank of Ireland, to discuss.
Thanks, Georg. I have a folder on my computer desktop called Papers to Read. And papers come out and I put them in there and intend to read them, but they rarely ever come out of that folder. I rarely get to read them. So I probably call it papers that I never get to read. But when Georg's paper came out end of last year as a working paper, right, at the ECB, it went straight into that folder. But I didn't get to look at it till David asked me to review it to be a discussant here for this conference. So thank you, because it's very interesting and it's very important. So how is it interesting? Well, you've heard a lot of the cool results that Georg talked about, but I think some of the innovations in the paper are really interesting. The Pasch versus Lespers brought me right back to first year economics and the statistics module. And you know, that innovation is so simple. It's one of those when you read the paper and you go, I wish I thought of that. So that is really interesting. It's also really important because, you know, a lot of the papers, I don't know if you noticed that Georg cites at the beginning, it's all US data. So what we have here is European data for European countries, specifically Euro area countries. And it's one of the few papers that digs into that. Also shopping behavior. It made me reflect on a lot of things I wrote during the inflation surge about heterogeneity and inflation along the income distribution, other household characteristics, where I didn't consider this shopping behavior because I didn't have the data. But it does make me realize this shopping behavior is really, really significant and we should take it into account. So it's a very important paper. Lastly, what it's all about, which is the heterogeneity of monetary policy. Actually, I think it's an important result, but it's almost like it's so small, I think, relative to what we see in other sources of heterogeneity in monetary policy. You know, I found a lot of the other results probably more interesting, in fact, but it's an important result to know that, you know, it's not a very big result in terms of heterogeneity. That's my view. Okay, so a quick recap. So kind of got four main findings. So the first one is these stylized specs on differences in expenditure shares across the income distribution. This is very well known in the literature. So Georg finds that for the period he looks at, inflation on average is slightly higher for lower income households, tends to be higher when inflation is higher. And we saw that during the last inflation surge, but not taking account of changes in shopping behavior. So well known in the literature, but we don't have a lot of Euro area or European data on it. So I think that's a nice bit of analysis. Second key finding, you know, how do exogenous monetary policy shocks impact what he calls household-specific inflation? So very nice to see it goes in the right direction. Bigger impact for these fast-moving consumer goods. And in the paper, I think one of the rationales for that is the exchange rate channel, which I think probably makes sense. Monetary tightening with common prices. So inflation for high income groups falls by less. And this is kind of the basket story. So lower income consumers can substitute more within their basket. But with the income-specific surprises, we get this opposite effect. Well, mainly because high-income households can shop around. So it can change the quality of the goods that they buy, but within the same narrow categories. Okay, the other key finding, like I said a minute ago, this really nice innovation by comparing the PASH and the spares indices. I wish I'd thought of it when I was writing some pieces. But you get this really nice result. On average, low-income households substitute more effectively, especially when prices are small. And one of the comments I'm going to have is, how would you think all of this might look during the most recent inflation surge? And I think you might get very different results, because as you show, you move towards zero there with the PASH index in terms of the differences. But this idea that product substitution is an integral part of shopping behavior, I think is a really, really important result. The differential response of shopping behavior, having showed shopping behavior to monetary policy shocks, I think is another really interesting aspect. And particularly the contrary results. So the different consumption shares implies that high-income households respond relatively less to monetary policy, but then the different shopping behavior shows that they respond relatively more. And I think that the scale of the two results is roughly offsetting, right? So roughly net zero, yeah, which again is interesting. Okay, so I have a bunch of questions and really high-level comments. Interesting and important paper. So interesting and important. Georg didn't say because he's too modest. It's already going to be published in a really good journal. So the thrust of a lot of my comments is about what you might do next. And knowing Georg, Miguel and Michael, I'm sure you're already thinking about all of the papers that will come. So one question I had was, what about the other 60%? So you talk about across the income distribution, whereas really you're just comparing the top 20 and the bottom 20. Now, I think if you looked at basket shares, all that stuff, you do get this, kind of monotonicity. So I don't think that's going to be very different across the income distribution. I just show it here for Ireland. The headline HICP during different periods, particularly during the inflation surge, you can see it was higher and then declining as you move up the distribution. But in terms of the behavioral story you tell, I'd imagine you get very different behavior according to maybe other household characteristics that might be in the middle of the income distribution. So I don't know if anyone has teenage daughters, but when I substituted to cheaper shampoo during the inflation surge, that was an absolute no-no. So my ability to substitute to lower quality products is really not feasible given the characteristics of my household. So I wonder, have you looked at that, or do you plan to do that in future work? I think that would be pretty interesting. Kind of the other households, not just the top and the bottom. Okay, the GfK Kantar. So this is the fast-moving consumer goods, the monthly data that they build up, which is really cool. It's a lot of really, really detailed data work. This is great data because you get a large number of similar items with different price levels within the same quite narrow categories within food. So this is how you can tell the substitution story or the shopping around story. Really cool for that. But I wonder, and I think Georg hinted at it at the end, is this substitution or substitutability likely to be the case for other HICP items? So when we think about more broader product categories, when there's a shock, it could be an income shock or it could be a monetary policy shock. We know that durable spending tends to be the most sensitive. So substituting straight out of durables, for example, or between very expensive to cheaper durables. So I wonder, is substitutability in other products likely to be similar for this FMCG group? I actually think it's probably greater. So maybe you could talk about FMCG results as maybe a lower bound. I don't know, I'd be interested in your views on that. And I'll skip the look through part. I wonder, could you use the consumer expectation survey that the ECB has been running for quite a few years now? So that had questions, if I remember, during the peak of the surge about not how households respond to monetary policy per se, but how they responded to changes in the price of goods in their basket. I think it did have questions on that. It'd be interesting to see whether the qualitative responses in the CES survey conform with kind of some of your hypotheses in the paper. The version I had didn't have a lot of the country level results, which you've added here, and I think you said you added them for the journal as well. The referees asked for that. I think that's really interesting. That was one of my other comments. It would be good to see more of the 6 country results. How do countries differ? how does that relate to maybe institutional or characteristics of how retail or FMCG is set up in those countries. But I see you've done that and you've got some cool results there. So I didn't see that before. I started out trying to look at the Foreman's shocks, so the Mumpal shocks from Jarochinsky and Garati. And this is a little bit unfair because you do say in the paper, the confidence intervals are wide. But I think I can be unfair because it's already accepted for publication. But, in the shock series, this is the monthly series, the bars here, it's obviously uncorrelated with here, the macro variable is inflation, but you have lots and lots of observations of no shocks. Okay, so I wonder, do you kind of have a power problem? And you do kind of almost admit to that in the paper where you say, maybe you don't have enough variation in the shock series to really get very precise estimates. And if you do look at some of the confidence intervals, they are quite wide. The other thing I would say is that the shocks during the period, which is this kind of shaded piece here, they're pretty much all on conventional monetary policy. So I wonder, would your results differ if you looked at just, say, interest rates as the policy lever? I don't know. Maybe not. Be interested in your views on that. Another extension you might look at is not just the Mumpal shocks, but the information shocks. So that's another series that Jarochinsky and Garati published. So this is the additional information that's in, say, the central bank decision that maybe we think inflation is higher in the future. It'll be interesting to see how that affects household behavior. Okay, so what exactly are the channels here? In fact, I'm going to skip this one because you were actually pretty detailed on that in the presentation. I don't have a lot of time. Okay, one that I was particularly interested in, and there is a bit of a literature on this. So Lesper's overstates inflation because it doesn't allow for substitution. Cash might understate inflation. So where do you think the truth lies? And for me, I wrote papers on just policy papers on inflation heterogeneity during the last inflation surge. It'd be really interesting to do a Pash and Lesper's during that and work out, maybe with a Fisher index, a geometric average of them, where did the true inflation lie? Because, I wrote papers that were taken up by guys who set minimum wages in Ireland, the Low Pay Commission, which really emphasized much higher inflation for lower paid households. But maybe there was much more substitution there than I realized. So I think getting to the bottom of this would be quite interesting, particularly during the recent inflation surge. Overall, a really great paper, sheds light on the previously unexplored channel of monetary policy. But I think that the net effects of kind of the monetary policy heterogeneity story is actually quite a small story, but important. Uses European data, that's great. Shows the value of this micro data, super expensive. So it'd be interested to know, are you going to extend the series and do more work, particularly for the latest period? I think the question of substitutability really lingers over this recent period of inflation, high inflation that we've had. So it would be great to extend it, not just for monetary policy, but also fiscal cost of living measures. I also talked about the minimum wage example I gave there, but also fiscal cost of living measures. So I look forward to seeing post 2008. Is there an asymmetry story? Do you think tightening might be different from loosening? That was just a thought I have. I don't really have strong views on why that might be the case, but I wonder, had you thought about it? Does the state of the world matter? So if you tighten when unemployment's already very low, say at or close to U star, does that matter? Because that's kind of the channels where behavior is changing. And like I said right at the beginning, look at other groups, not just incomes. Like I'd love to know, are households with mortgages more sensitive to monetary policy shocks versus households without mortgage? So that's it. Great paper. Really enjoyed it. And thanks.
Thanks for your discussion. Let's pick up some questions from the audience. So we have Paul and Leo right here. It's the front.
Thanks, Gail. That's Michael McMahon. It's a super interesting paper. I think the point about constraints and substitution is one which UK followers of Twitter will have picked up from Jack Monroe, who made a big case about this. And I think if you explore this in the next paper, I think the interesting one would be to try and build in things like not just quantities, which are, of course, something you can struggle to deal with, but also if you could do things like substitutions towards goods or bads. So for instance, if you start downgrading the quality of pizza, it might not, or pasta, it might not taste as good, but maybe it has the same nutritional content. But if you start, shifting to really cheap sugar-filled things, maybe it's really bad for the welfare. And I think if we start thinking about this in welfare terms, not just raw inflation terms, I think that could help.
Thank you. So I agree. It's a super interesting paper. So, so two questions. One, I was a bit puzzled by the shopping habits. Finding it. My prior would have been, the opposite. And let me give you an anecdotal example. So my disposable income was cut by more than half when my kids moved to study in England. I really had a cut of half. Half of my disposable income fell, within a month. And I discovered, I started to pay much more attention to prices. So before I was going to supermarket, I would not look at prices at all, or really at all. And I would buy like, fish and not look at all at the price. But since I have this a big cut in disposable income, I do. So I don't know if other people behave like this, but I was surprised that high income, do more kind of shopping around. I would have expected the opposite. So I wonder if you have thoughts about that, or if I interpret your result correctly. And the second question is, it looks to me that your analysis is not really dependent on monetary policy shocks. What you're looking at is heterogeneity in inflation and substitution, and this applies to any change in inflation, actually. So I don't think that your analysis is specific. So I'm not sure you need all this identification. I understand the question, of course, you want to see, what are the effects of monetary policy shocks and so on, but I think, as far as I can see, nothing in your story, hinges on monetary policy. And also people don't know if I don't care if movement in prices come from monetary policy or other sources. What I care is that there is a movement in inflation and they react to it. So I'm not sure you really need all this identification with your shocks and so on. That's my impression, but thank you.
Okay, we had one more question just here in the front, right here.
And actually, my question follows up on Livio's quite closely, but from a different perspective. So, it's a great paper, really interesting results. I do wonder as you connect it to the monetary policy implications and welfare and the other work on heterogeneity, if your results actually are a little different than in that literature. So if one thinks about the effects of monetary policy on unemployment and how that affects a different set of households across the income distribution or skills distribution or what have you, right, there's a effect there where unemployment goes up and it goes back down to zero, and there's sort of an intervening. I think it's a little different in the case of inflation, right? If it's the case that monetary policy doesn't actually, in the long run, affect the relative price of an apple and an orange, I'm going to posit that that's true, that that's determined by supply and demand in those markets. Then if you have a period in which there's differential inflation for an apple and an orange following a monetary policy shock in one direction, you have a subsequent period in which is in the opposite direction, right? And the net effect is zero. And so I wonder if the welfare implications are just fundamentally different for relative price shifts. They're important, but different than those on the income side.
Okay, and Jenny, did you have a question? There's one more question just up in the... A question that's kind of related to the previous comments as well. What does this imply for, once these shocks dissipate, what does it imply for inflation rates of other parts of the consumption basket, and also for firm behavior and the behavior of markups in those other parts of the consumption basket?
Okay, thank you. Well, many comments. Thank you very much, and many interesting questions. Well, let me address a few of them. So, on the other parts of the consumption baskets, as said, we have something to say about food and beverages, and I agree that one could probably extrapolate that this also applies to clothing. For durables, it's speculation in the sense that this data's durables consumption, you don't observe this regular purchases, right? You have to basically have a model in mind and say, yeah, I believe that buying a piece of furniture again, you would substitute in some sense. With energy, it's probably a different story because there you basically have a commodity with one price. So some parts I think you can extrapolate, other parts you can't. And of course, the proof of it is the rest on the data availability. About other income quantiles. So, I mean, one can show very nicely that these inflation rates line up very nicely with income. So low income, both in the last pair and in the partial, you have this. So we chose the upper and the lower one just to have this maximized difference to have some action. And that brings you then directly to the question, why monetary, do we have a power problem? Well, we are a little bit constrained, right? We can't pick our sample period as freely as you can do with the aggregate approach. So we are kind of exposed to this period. And so it's tempting to follow your approach, and maybe we should actually do this to do an exercise without monetary policy shocks and just look at inflation rate differences. It would be interesting to see what happens then. The monetary policy shocks, they have an advantage relative to the pure interest rate or inflation rate because it applies also on the economic outlook. And some of this behavior of the high-income households, if you think through it, only really makes economic sense when you say they have a decline in their future economic prospects. And this is the reason why they're actually responding like this to monetary policy shocks, because you would expect that after tightening prices go down. So in a way, this would actually open up substitution options in the opposite direction. So so the story goes better with the monetary policy shocks, but we haven't tried the other one. I'm not sure about if I understood your comment about the shopping habits, because in that line of what I just said, the idea is that this monetary tightening actually is like sending your kids to a UK college. Basically reducing your disposable income and therefore driving you to more stores. Yeah. But the high-income households get this shock, and what we show is you are a high-income household. So, and in response to the shock, they respond more. I mean, in some sense, this is the surprise. I mean, indeed, it is the surprise that they do this. It's scope. But you can, of course, say that the low-income households already shop around a lot. And so there is not much extra benefit from doing this. So it's really about the increment relative to the previous situation, not the level. Then what else do we have? So about the true inflation. So that's a good point. The Fisher index. Well, I think there's a debate about what the true inflation is. So on last pair, we can all agree. Statement, it overstates. Partial, we all agree, it understates. Whether geometric average is true, I don't know. We could go for adding Weinstein and estimate taste changes. So I guess I'm not going to want to go that route. It's probably, I feel most comfortable to stay with this extremes. I guess there was a question about other quality upgrades, downgrades, right? So we could do more. We did it so on passing. We did like a candy exercise and checked if candy consumption goes up or down, but that didn't reveal that much. So so we looked at some product categories where we had a prejudice, a prior on whether this is good or bad, and that didn't really react that much. But maybe one could do it more sophisticatedly. But you have to classify products. Just saying that candy is bad didn't reveal anything. So we thought along those ways, but we didn't get very far. I think these were the main comments. But if I didn't address one, just talk to me afterwards. Thank you very much.
Wonderful. Thank you to all the presenters and discussants. 3 really interesting papers and discussions.